Hello, everyone. Again, I'm Teacher Jonna. I welcome you to our class in Fundamentals of Accountancy, Business and Management 2. This is open to all grade 12 students. Okay, our topic for today is how to prepare the statement of changes in equity. Remember, in our previous video lessons, we discussed how to prepare the statement of comprehensive income or the income statement and the statement of financial position or the balance sheet. And now we are going to prepare the statement of changes in equity. Okay, join me. But before that, we need to be familiar with the following terms. Okay, what is a statement of changes in equity? Well, this is a form of financial statement which shows the contributions of the owner or owners in the business. It also shows the different activities or the different events that happened in the company which had affected the equity account. Okay, number one, we have the equity beginning. Equity beginning represents your initial investment to the business. Okay, but when the business has been operating already for several years, we get this equity beginning from the equity at the end of the previous year. Suppose today is 2020 and we are preparing statements for 2020, we get the equity beginning from the previous year, 2019, equity at the end. Okay, we get the equity balance at the end of the previous years and it becomes the equity beginning in the current year. Okay. So now let's go to the additional investment. During the operation of the business, in the middle of the business operations, the owners may think of adding some more investment. It may be in the form of cash, inventory, machine, or other forms of investment. They would add, add investment to the company for its operation or to facilitate the increase or to facilitate the business operation or to just to increase the profits of the business. Okay. Next, we have the net income. Remember the net income in your income statement or the statement of comprehensive income? In your grade 11, you studied that the net income figure is being close to your income summary, and then it is again close to the retained earnings or the statement of equity account. Sorry, it is close to the equity account, and now here it is. It appears in the in the statement of changes in equity as an addition to your equity account. However, if there is a net loss, you deduct the net loss to your equity account. Okay. Then we have the drawing. The drawing is the withdrawal of the owner to the company. Maybe he needs some money for his personal use and he would want to get some in the form of withdrawals or drawing. So this is a deduction to your equity account. Okay. Now, but the statement of changes in equity varies in different forms when we deal with different forms of organization. As we all know, sole proprietor is owned or managed by a single person. So when a business is operating on a sole proprietorship, we call it the statement of changes in owner's equity. Okay. So, but when the form of organization is in a partnership, by the way, what is a partnership? Well, our civil code tells us that the partnership is 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 a form of contract wherein two or more persons would bind themselves together. They would contribute money, property, or their talents or their industry to a common fund, to a common fund with the intention of dividing the profits among themselves. Okay, so these people who combine their property, their talent, their money, their other assets are called as co-owners, or if it is a partnership, they are called partners. Okay, so in a partnership wherein they have this association of two or more persons, they have an agreement which they call partnership agreement. Okay, in their articles of partnership or partnership agreement, they may they may decide on how to divide the profits among themselves. It may be equally or according to the capital contribution. And also, partnerships can be seen in all forms. It may be in the operation of common retail establishments, in small manufacturing companies, or in the practice of profession. So we may see some CPAs, lawyers, doctors forming a partnership. The question is, how many members in a partnership? How many members can be called as partners in the partnership? Well, it varies, but the minimum is two, and it may, if it is a national or a larger scope, a multinational company, it may even be up to 1,000 partners. So it varies into the intent of the partnership. Now we go to the corporation. When we say corporation, the corporation code defines it as the what? It is the it is an artificial being created by operation of law and having the right of succession, the powers, attributes, and properties expressly authorized by law or incident to its existence. Meaning, uh, when a corporation is being formed, it is it has it has its artificial be it is becomes sorry, it becomes an artificial being. It is treated as a separate entity from the owners, from the stockholders. Okay, we call the owners in the corporation as stockholders or shareholders. And it has been created by operation of law because there is a law, a legal body that has its rights and powers, which is managed by a group of people called the board of directors. Okay, so it has the right of succession. When a member of the board, or even the death of a shareholder or a board member, it does not dissolve the existence of the corporation. Still, it continues its existence. It has the powers attributes, meaning they can perform their functions as mandated by them in their charter. Okay, but they cannot do actions beyond their powers. They call it ultra vires act. They should not perform actions beyond their powers. Okay, so that is the picture of a corporation. And in a corporation, we call it also the statement of shareholders equity. Now we start first with the sole proprietor. In a sole proprietor, the statement of changes in owner's equity is being used. Again, the formula is the equity beginning or the initial investment of the owner plus the additional investment plus the income for the year less the drawing less the net loss. Then we get the total owner's equity at the end. Okay, so that is for the sole proprietor. Now we go to the partnership. For the partnership form of organization, we have the statement of changes. Okay, again, this is the statement in owner's equity. Now we go to the partnership. Okay, the statement of changes in equity for partners. Well, as we have said earlier, it may have two or more partners or two or more persons who contributed their money, their assets, their property, their talent, their industry, and they have the intention of dividing the profits among themselves. Okay, so this is it. In our example here, I'm showing partners X, Y, and Z, and they have a partnership agreement under the Articles of Partnership, and they will divide the profit of 1 million. Okay, so let's look at this statement. The statement of changes in owner's equity. Well, the heading says XYZ partnership. Statement of changes in partners equity for the year ended December 31, 2019. You state the names of the partners at the top, XYZ, and then the changes in the equity account. We have the equity beginning, their different shares. Partner X shared 1,000, partner Y 200,000, and partner Z shared 300,000. Then there is a net income of 1 million. So how will you divide, as the accountant of this partnership, how will you divide the income among the partners? Well, you go back to the partnership agreement. If there is an if if it is stated that the income is divided based on their capital contribution, then you get the capital contribution of each. So 100,000 for X, 100, 200 plus 300 is equal to how much? 5 plus 5 plus 1 is 600. So they have the total capital, our total equity of the three partners is 600,000. You get the pro rata, or the capital contribution of X, and divide it by the total shares. So 100,000 divided by 600,000, it will give us 16%. Okay, 200,000, the contribution of Y, divided by the total number of equity, which is 600,000. 200 divided by 600, it will give us 34%. And 300 divided by 600, 300,000 is the share of Z, and you divide it by the total capital contribution of XYZ, which is 600. So 300 divided by 600 will give you 50%. So when you divide 1 million, you divide it pro rata, or according to their capital contribution. So if the profit is 1 million, how much will X get from the profit? So 1 million times 16%. So that is why we have 160,000. Then 1 million times 34%, the contribution of Y is 34%. So 1 million times 34 will give you 340,000. And now Z has 50% contribution. So 1 million times 50% will give us 500,000. So if we add them all, 500 plus 340 plus 160, if you get the total, it will give us 1 million. So we have divided the profits according to their capital contribution. Ma'am, in the absence of the agreement as to how they would divide their profits, well, we divide the profits equally. Okay? Then here is the additional investment of each partner. Partner X made an additional investment of 16,000, partner Y 34,000, and partner Z 50,000. But we have to deduct their withdrawals, or the drawing of each partner. So less 20,000 for X, less 30,000 for Y, and less 50,000 for Z. Then it will give us an equity at the end of 256 for X, 544 for Y, and 800 for Z. Okay. So, but later in your higher accounting, you will be dealing much on the partnership accounting. There are so many things: the liquidation, the distribution of profits and losses, the dissolution. But for now, we will just give you a bird's eye view of a statement of changes in partners equity. Okay, then we have also the statement of shareholders equity. Okay, let's go back to let's start from the top. The heading says MNO Corporation. So this statement belongs to a corporation. Again, we have studied that in a corporation, the owners of the corporation are called shareholders. Okay, so when we call them shareholders or stockholders, they have their own set of terms to use also. First, we have the equity beginning. Okay, so the initial investment of the owners or the shareholders. Then we add the issued shares in cash. This is the outstanding shares, outstanding stock that are in the hands of shareholders, which were purchased in cash. Then in issued shares of stocks, it may be the common stock or preferred stock, but it will be discussed later in your college years. But this is only a bird's eye view of the statement of shareholders' equity. So you add the issued shares in cash. It has also its paid in your college years. We call it the paid in capital. That is the stocks where this is the amount of the stockholders have invested in the business. So then we have the treasury shares or the treasury stock. What do you mean by treasury stock? Well, treasury stock, it means the stocks owned by the corporation, then they have issued it outside, they sold it to the public, and now they are going to buy them back. So what is it again? It is the corporation's own stock that it has issued, and later on they reacquired it again. Okay, so they bought again their own stock because for some reasons, maybe they would want to distribute to the officers and employees as part of their bonus plan. So they would want to distribute stocks to their employees or to their officers, or maybe they just want to increase the earnings per share. So to increase the earnings per share, you have to reduce the number of shares outstanding. Okay. So, and also maybe they just purchase their own stock, or they have this treasury stock maybe because they would want to increase the net assets of the company by buying its shares low and hoping to sell them for a higher price. Okay. So that is what you call the treasury stock. Then we have the net. Again, there is a question here. What is the effect of treasury stocks or treasury shares? Well, we have to take note of three things. The treasury stock should not be viewed as an asset. Okay, so it is not an asset, and it should be reported as a reduction. Take note, it is a minus to your equity account, and there is no income or there is no loss in the purchase or in the reissuance or in the retirement of treasury stocks, and the retained earnings can be decreased by the treasury stock transactions, but it is never increased. Okay, take note of that. The treasury shares reduces your equity account or here there is no retained earnings, but they used here net income. Okay, when we talk of corporations, we will encounter the term retained earnings, or here it is stated as net income. So what is this net income or the retained earnings? These are the accumulated profits. So for the for your income realized on this year will be added to your equity account or the shareholders equity account. So retained earnings, these are the accumulated earnings or profits that are retained or kept in the corporation. Okay. Now we have these shared dividends. Why do we have dividends here in the corporation? Okay. So when we say dividends, it it means the distribution, the distribution of earnings or profit among the stockholders. Okay, how do you compute for the profit? Uh, you base it on the number of shares held. Okay, so it goes this way. I would want to be a shareholder of MNO Corporation. I would want to buy 100 shares at 10 pesos per share. Okay, so 10 pesos times 100 shares, how much is that? 100 times 10, so 1 to 1,000. I am not really good. 100 times 10, yes, 1,000. I have 1,000 shares of stocks in MNO, and they would give me dividends in accordance to the number of shares I own. Okay, so that is how they distribute the dividends. Dividends again is the distribution of profits among the shareholders. Okay, the distribution of profits may take in the form of cash or other form of assets, or it may be in the form of stocks. Okay, so what is the requirement for them to distribute dividends? First, there must be enough cash. Next, there must be an sufficient and appropriated retained earnings for distribution. And next, there should be a declaration by the board of directors. And who is this board of directors? Okay, when we go to corporation, the organizational structure looks this way. On the top, we have the shareholders. Then the shareholders would vote for the board of directors who will manage the operations of the corporation. From the board of directors, they select their CEO or the president, then the employees. Okay, so that is how a corporation works. Then when we deduct the dividends, we get now the final equity at the end. So there is somewhat slight difference, but it's vital. It's vital that we learn these terms so that when we enter our college years, there is already familiarity with the accounts that you will be using. Okay? Now, I have prepared here an activity 4. Okay. Activity 4 states that we prepare a statement of financial position and a statement of changes in owner's equity with the following data. Okay. So I presented some data, some information, and the question mark is the capital beginning, total assets, total liabilities and equity. So we will be preparing the income statement. No, not the income statement. The statement of financial position and the statement of changes in the owner's equity based on the following information given. Okay. I think you can get it. It's only easy. You will just need to use your various lessons in the basic accounting equation, how to solve the balance sheet, how to prepare the balance sheet, and the income statement. So I think that's all for today. So thank you very much for watching and studying with me the preparation of the statement of changes in equity. Okay, thank you very much. And see you again next week. I am at your service, ABM with Teacher Jonna. God bless everyone.